You know, in 2 sections from now on, one will feature other members of the team and their newest research, or what they're thinking about regarding breaking news. Then, we'll go into the drill. But even before the drill, the markets are moving very, very rapidly, as I'm sure you've noticed. The stock markets are correcting quite significantly. The correction we've seen in the last week, bond yields are falling fairly dramatically, commodity prices are falling and in some cases, breaking down. Yield spreads, meaning the spread between high-yield bond rates and treasury bonds, are starting to gap out. So fear is seeping into the markets in many ways and across many indicators. We do have a point of view, so I'd like to introduce it. You've heard it here before if you've been listening. But for those who haven't, I'm going to say this is slowly, then all at once. We'd have been talking about the rolling recession that has been in place since the Fed started raising rates in 2022. As soon as the Fed started raising rates, housing effectively went into a recession. Commercial real estate, especially office real estate, was already in a recession. Now, multifamily real estate seems to be an issue as well. We've seen autos stall out. They kind of stabilized but are stalled out at subpar, meaning subnormal expansion rates. We're seeing capital spending come down. We're seeing consumer confidence relapse. Housing was starting to pick up, but it has relapsed again, certainly if you're looking at sales. So we've had a rolling recession, and now we seem to be in the all-at-once phase. Many people are beginning to understand this, and we think that perhaps the idea that inflation is the problem has been misplaced, and that this rolling recession will end with prices coming down. I've been saying that the risk is deflation, prices coming down. Listening to Amazon's report last night, it's clear the consumer wants lower prices and is getting lower prices. The consumer is not falling apart yet. They're actually responding to some of the lower prices, even in autos. But nonetheless, falling prices are a problem for companies because it means their margins will compress. So, the all-at-once phase has to do with deflationary signals. This week, we got the PMI, Purchasing Managers Index, and today, the employment report. Both are recessionary indicators, so this idea that we're in a recession is beginning to gain more traction. In fact, that S rule in the unemployment report, essentially the unemployment rate going up by 50 basis points, as measured on a 3-month moving average basis relative to its low, was triggered, and so more people are now thinking recession. Now, we're not thinking that all at once means anything like 2008 to 9. In fact, the rolling recession aspect of this scenario argues against that. So, we're not suggesting anything of that magnitude, but we are suggesting that the focus on pricing power will be significant. The reason this is significant is that in the early 80s, when Fed Chairman Volcker was trying to strangle inflation out of the system with double-digit interest rates, inflation was also in the double digits. So if he was going to make a mistake, there was a big buffer to absorb the impact. Our inflation rates today are much lower, so the Fed actually has less room for error. I do believe that this higher for longer stance and the idea that inflation was the big risk out there have put us somewhat in harm's way. But half of the solution is understanding the problem. So I think this cathartic moment is good. It's painful in the very short term. These corrections, because there's a lot of confusion. Many people assume that the world would work one way, and now all of a sudden, it's not. One thing you'll hear about increasingly in the news, I think, is the idea that the carry trade, which involves, believe it or not, the yen, is unwinding. So if you look at what people mean by the carry trade, it means that many investors and speculators borrowed yen. So they were effectively short yen. They borrowed yen because interest rates in Japan were so low relative to the rest of the world. They borrowed there and then redeployed those assets into dollar-based assets or other currencies, but primarily into dollar assets, often U.S. Treasury bonds, which were yielding more. Since 2011, the yen has either been depreciating or stable, so it was kind of safe if you were betting to short the yen or borrow the yen. You weren't taking that much risk. In fact, if the yen went down, you'd benefit from that. Plus, you were earning higher rates in the U.S. Some people think part of the carry trade was borrowing yen and then buying. This version keeps the original content and length intact while correcting grammatical errors. Let me know if you need further assistance. Yes, I believe it's pretty deft, but I'm not sure. Sock, What do you think about this huge cash boost and what Warren Buffett and Berkshire Hathaway are thinking? Is it that he gained weight at Apple, or is he hoarding money because he wants to make inexpensive purchases as the recession approaches? Or, to put Freebird's point, regulation. Buffett was sitting on the largest cash pile he had ever sat on, according to this chart that many people shared online during the global sell-off that occurred on Sunday and Monday. People aren't really discussing this because of the market recovery that followed, but it makes sense that Buffett is accumulating a war chest here and is in a relatively defensive posture. As you can see, he began making a lot of investments in 2021 to 2022, which caused the cash pile to decrease. Given the size of his cash pile, it would seem reasonable to assume that he believes that public stocks currently provide a poor risk-reward ratio and that he is, once more, slightly more risk-off. Chamath, how do you feel about the regulatory risk argument that Freeberg is putting forward here? Since he also sold a lot of BUID, which they have owned since 2008, I believe David is correct when Freeberg says that the China issue might have had an effect. You know, there's a Chinese electric vehicle manufacturer, so that might have contributed. To tell the truth, I have no idea. Hold on, you're implying reliance on China? He might have thought that the portfolio as a whole had too much reliance on China, because both of those depend on it. Perhaps yes, that's something I could purchase. That makes a fair amount of sense. However, it's important to keep in mind that these choices have been considered for at least a few quarters. Recall that the letter he sends was drafted months and months ago. It wasn't written yesterday. Therefore, I believe that these choices were made some time ago. If we're going to play conspiracy theorists, another reason is that, Charlie Munger may be beginning to compile the book in preparation for the smooth transition to Greg Abel following Buffett's death. You're implying that he wants to transfer it with less risk when you say that? Therefore, there would be a risk associated with relying solely on one stock or China. In order to facilitate a smoother handoff, he wants to make it extremely tidy. He wishes to pass down a well-structured book, or perhaps